Hey, good afternoon, everyone. Marty Mazzora here. It's Friday, the 24th of November, 2023, with your weekly economic update. Going to keep it relatively quick today, and I'll just touch on equity markets briefly at the end. In front of you is our simple graph of our PWA index. Stayed the same once again this last week, still negative 29, which is well within the territory that suggests recession odds are high over the coming months. We'll start with weekly mortgage purchase applications, actually the third week in a row with an increase. Clearly the direct result of slightly lower mortgage rates. They're now in the 7s as opposed to in the 8s. Consumer confidence, another update of the Michigan Consumer Confidence Survey. Consumers remained quite concerned about their current and go-forward prospects. Initial jobless claims actually came down to 209. The estimate was notably higher than that. Still, the trend off the bottom is what it is, but that's a low number historically, and a lot of attention was given to that. I will say that continuing claims continue to go in the wrong direction, and this is something to closely watch, as I continue to point out, in terms of what it says about prospects for either continued growth or recession going forward. Durable goods orders came out this week, and on a headline basis, they really dropped. The truck tonnage, however, did pick back up a little bit. Leading economic indicators just came out this last week. That ratio that we run, the leading index to coincident index ratio, as I pointed out, and I think I did it here just in my midweek update, sits at areas that we just haven't seen without either being in or being very in close proximity to recession. When you look at the two components separately, you can certainly see the history of it, right? Leading indicators rolling over pretty consistently before coincident indicators. There's typically a lag, not much of one there, and history suggests that there's quite the come down in coincident indicators, and that typically coincides with a recession. The Chicago Fed National Activity Index, it's an index within our index. They have 85 inputs, and their most recent reading for October, 61 inputs read negative, only 24 read positive. So that is not a good look in terms of the state of the economy. Copper, however, actually I took from negative to neutral. We poked above this downtrend line here a bit. And as I pointed out here a few weeks ago, this is actually a bullish pattern for the price of copper, a downward wedge with very nice bullish divergences here on the momentum. I think it speaks as much about China and the prospects for Chinese stimulus going forward as it does the state of the global economy. And just to finish up on the economic report here, let me borrow once again from Peter Bookbar's highlights with regard to some recent earnings announcements. And on the positive front, Burlington said that during the quarter we were very pleased with our back-to-school trend, and their quarter-to-date comp growth through September was slightly ahead of our guidance range. So overall, Burlington sounded a pretty positive tone. Dick's Sporting Goods also had a very strong back-to-school season driven by our best-in-class athlete experience and differentials assortment, whatever that means, but they were pretty bullish on certainly what they've seen, and they weren't bearish on their go-forward outlook. And then Analog Devices, encouragingly, during the fourth quarter, we've seen cancellations fall and bookings stabilize. This gives us greater confidence that the ongoing inventory correction will taper through the first half of the fiscal year. So there's three that sound somewhat positive under present circumstances. In terms of the negatives, Best Buy, we are reporting a comparable sales decline of 6.9%, which is slightly below our outlook for the quarter as consumer demand softened through the quarter. The sales pressure is due to many factors, including the pandemic pull forward of tech purchases, the shift back into services outside the home like travel and entertainment, and inflation. In the more recent macro environment, consumer demand has been even more uneven and difficult to predict. We've been showing that, I think, here in our assessment as well. Nordstrom, we continue to see a cautious consumer, and it remains to be seen how changes in inflation, higher interest rates, and the resumption of student loan repayments will affect discretionary consumer spending during the holiday season. Traffic has been soft. Our average order sizes have gone up, but traffic has been down a bit. From Lowe's, comparable sales decreased 7.4% due to a decline in do-it-yourself discretionary spending, partially offset by positive pro-customer comp sales. From Hewlett-Packard, the challenging external environment constrained demand across the industry, and this is reflected in our full year results. And lastly, Analog Devices, something from their call that offsets the positive that I just told you. We continue to see broad-based weakness across markets and geographies as customers work to reduce inventory in a stressed macro backdrop. And folks, those last three words, stressed macro backdrop, is what has had and continues to have our attention going forward. Okay, so that's it for the economic update. Let's just quickly focus on just equities today, and I'll talk about the S&P, the NASDAQ 100, the ETF that tracks it. We'll look at small caps and then a couple things on sentiment, and then we'll be done. Okay, so the S&P 500 daily chart actually closed a tad higher today. It was pretty much near the flat line during the shortened trading session today. Again, this is an all-time highs. This is 2023 highs. And, getting close there. You can see just a real acceleration here in momentum. You don't have bearish divergences, but you do have extended overboughtness here on the S&P. Looking at the hourly chart, you really have, I would say, really kind of an extension of this rising wedge pattern up in here. Here's today's action against really notable bearish divergences. So while I'm not necessarily bearish for the year end for equities, right now over the next few days to a week, based on particularly these very short-term technicals, would not surprise me in the least to see a pullback before the resumption of that year-end rally, if indeed we're going to get it. And then on the NASDAQ 100, you can see poked just above this year's high and was down a little bit today, but stayed just above that line as well. On this one, though, we do have, from this point, what are going to be bearish divergences. If we had a day or three above that line, then you're going to have these momentum divergences in a bearish fashion. On the hourly, not a good short-term technical look at all, frankly. This is a very bearish technical look. Doesn't have to play out that way. Lots of things could come up to blow through this and make this a false signal. But right now, if you broke down below the bottom of that wedge, you should see around that 380 range, at least to begin with. As for small cap stocks, a Russell 2000, this is the one-year daily chart. Again, we were flagging these gaps that this one got quickly filled. As we broke out of this one, we still have this gap right here that is yet to fill, if it's going to. And then we had this gap, which got filled 3 days later or so. Established this trend line right here, big fat gap right here a week or so ago. And this would be very short term. This would be an ascending triangle pattern, and it all depends on what you see down here. But this would suggest that odds favor an upside breakout out of this range right here. Now, you do have this pretty notable resistance. I'd say that's very potentially strong resistance right there, just above 1800, that you can see has been quite the battleground here all year. And let's just take a look at Fibonacci retracement line. So when you do these retracements, you go to the recent high. So what we want to see is to what degree have small caps retraced the decline off of that July high. And the key areas, as you can see, are highlighted here are the 38.2, the 50% retracement, and the 61.8. I can tell you technicians have these bullseyed on their charts. Interestingly enough, it's very, very close to the strong resistance line right here. So here, to get through here, there's really 3 levels of resistance. There's the resistance line right here, and the 50% retracement. Of these 3, it's the 50 that is most meaningful, right at the 200-day moving average as well. So small caps do have their short-term work cut out for them. If they were to pop that, I think you'd come right up here to this 62% retracement. You can see right where that falls, ironically, right where we've seen a lot of other action here over the course of this year. As for the hourly chart, We have what we'll call a symmetrical triangle right here in terms of the momentum indicator. You could say from here to here, bearish divergences, but you do have a buy signal on the MACD, and you do have these things beginning to slope up as well. So if I had to make a short-term call on small caps, I would say higher, but I can't say I have huge conviction. I will say this, just technically speaking, the setup looks more favorable right here, very short term for small caps, than it does, say, tech stocks in the NASDAQ or the overall S&P 500. And I do think from a seasonality perspective, the odds favor the bulls over the next few weeks. But of course, as we know, anything can happen, particularly in this environment. Now, speaking of favoring the bulls, one thing that does not favor them is sentiment. So you remember, say, 4 weeks ago when I was unambiguously bullish on a very short-term basis, and it played out like it should. That was an easy call to make. Well, at the time, sentiment was really, really, really bearish. Okay, so everybody seemed to be piled up on the bear side of the boat. Well, now we've got virtually the opposite. We have individual investor sentiment that has to be near the most bullish for the year. The spread there is very, very bullish. Advisors, let me just pull this one over. The bull-bear spread, this is an input to our own fear-greed barometer. It has popped up to 29.8, and as Investors Intelligence says here, we are just below the initial danger zone of 30. And the mid-October high before stocks really rolled over was 29.2. So again, this was very, very low prior to the recent rally. And I'll just pull this one over. I look at this. This isn't one of our components in ours, but the Citigroup Fear Greed Index, again, before this big rally began, it was over here at extreme fear, probably even lower as I recall. And you can see now it's moving significantly into the greed column. And our own fear greed barometer is 37.5 in the greed column. We score it a little differently. This would be greed, and we are about right here in our index. So basically it's saying the same thing. And this would be a contrary indication. It's saying everybody's starting to get bulled up over on the bull side of the boat. You get a little surprise, something negative in the data, Fed speak or what have you, this thing could quickly reverse, and you could see a fairly precipitous decline, even amid strong seasonality like the end of the year. And then, folks, we get into next year, and it's going to be a whole different proposition. But as it stands right here, I don't think the bulls need to lose any sleep. I think odds favor them a bit, as I keep saying. I think going into next year, if the data continue to evolve as it has, stocks could run into some real trouble, probably during the course of the first half of next year. But all I'm willing to hang my hat on is that the risk-reward setup is not favorable for anybody who has, say, a 12-month outlook right now. For someone with a several-year outlook, once we get through whatever is left in the current cycle, I think there are some significant themes to be exploited, and we'll go into the weeds on those during our lengthy year-end letter, which will start showing up here in the next couple of weeks. Folks, thank you as always for watching and listening. Hope you have a wonderful weekend, and I'll be back next week. Take care. Bye-bye.